Hey everyone, welcome back to Corporate Decoder. Today, UPBD just filed their annual report for 2025, and I'm seeing some interesting shifts in how they manage employee retirement money. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has been getting more focused on its core business, and that is reflected in how they're handling employee investments, especially when it comes to company stock and manager changes. This is an annual report from the Rent-A-Center East Inc. Retirement Savings Plan for Puerto Rico employees. Think of it as a checkup on how the money set aside for employees' retirement is doing. This filing covers the year up to the 31st of December 2025. First up, we have the auditors, Weaver and Tidwell LLP. They've given the financial statements a clean bill of health, meaning they believe the numbers presented fairly reflect the plan's financial position. This is pretty standard for these types of filings, but it is good to see they are verified. They've been the plan's auditor since 2023. Which suggests some continuity. Now, let's dive into the actual numbers. This table shows us what the plan owns and what it owes as of the end of 2025 and 2024. The total assets grew from about $5.7 million in 2024 to over $6.3 million in 2025. That is a nice increase, showing the plan is growing. The biggest chunk of the plan's assets is in mutual funds, which jumped from about $4.4 million to over $5 million. This shows a strong reliance on diversified investments, which is generally a good thing for retirement plans. Interestingly, the amount invested in common stock, which likely includes UPBOUND Group Inc. stock, decreased significantly. It went from around $340,000 down to about $158,000. This is a big change and tells us something about how the company views its own stock in employee plans. One item that grew is notes receivable from participants. This essentially means employees have been taking out loans against their retirement savings. This amount went up from about $580,000 to nearly $590,000. While loans can be a useful feature, a high balance here can sometimes be a sign that employees are relying on their retirement funds for immediate needs. This next section shows how the plan's value changed throughout 2025. The plan added over $1.2 million to its net assets and paid out about $600,000 in benefits and expenses. This resulted in a net increase of over $611,000, bringing the total assets available for benefits to over $6.2 million by the end of the year. Looking at where that money came from, investment income, which includes dividends and gains from selling investments, brought in over $549,000. That is a solid return. Contributions from participants and employers added another $625,000. This shows that both employees and the company are actively putting money into the plan. This plan is for employees in Puerto Rico, and it's worth noting a significant change happening at the beginning of 2026. The plan document mentions that the record keeper and trustee are changing from Intrust and Banco Popular to Fidelity. This kind of administrative shift can sometimes impact fees or service levels, so it is a detail worth keeping an eye on for participants. The plan itself is a defined contribution plan, meaning employees and the company contribute to individual accounts. Employees can contribute a good portion of their salary, up to $23,500 for 2025, plus a catch-up for those over 50. The company's matching contribution in 2025 was $0.50 for every dollar contributed by the employee, capped at the first 6% of their salary. But here is a key change for 2026, that matching formula is changing. Starting the 1st of January 2026, the company will match dollar for dollar up to 3% of the employee's salary, and then $0.50 for the next 2%. This means the company's match is becoming more generous for lower contributing employees. They also note that the company did not make any profit-sharing contributions for 2025, which is something to watch. This is a really interesting part. Before the 1st of January 2026, participants could invest in UPBOUND Group Inc. common stock, but there were limits like not exceeding 10% of their contributions or 50% of their total account balance. The filing explicitly states that beginning the 1st of January 2026, participants will no longer be able to make future investments in the company's stock. This is a strong signal that the company is phasing out direct employee investment in its own stock within this retirement plan. This mirrors a trend where companies might do this to reduce potential conflicts of interest or simplify plan management. And confirming that reduced exposure, the schedule of assets held at the end of 2025 shows the common stock value at $158,210, a significant drop from the prior year. It also lists participant loans separately, which we saw growing. The financial statements also break down investments by fair value hierarchy. Most of the plan's investments, like mutual funds and common stock, are classified as level 1. That means they are valued using readily available, unadjusted quoted prices in active markets. The stable value fund, however, is classified under level 2, meaning it uses observable inputs other than just quoted prices. It's good to see the majority of the assets are in easily valued categories. This note clarifies that the plan is considered qualified and its trust is tax exempt. This is crucial for a retirement plan, as it means earnings within the plan generally grow without being taxed until withdrawal. They also state that they have no material uncertain tax liabilities, which is always a positive sign. This section acknowledges that certain transactions involve parties related to the plan, such as investments in UPBOUND Group Inc., stock and loans to participants. It also mentions fees paid to Entrust and Nest Egg for services. It's standard accounting practice to disclose these, as they are transactions with related parties. This part is a reminder that investments always come with risks. They mention interest rate, market, and credit risks, and even global events like pandemics or conflicts can impact investment values. They point to the company's main 10K filing for more detailed risk factors. It is a general disclosure, but it highlights that the value of retirement savings can fluctuate. This is a technical note that reconciles the financial statements to another regulatory filing, the Form 5500. It shows adjustments for things like loans deemed as distributed, which is a way to account for loans that are no longer being repaid. It's an internal reconciliation for reporting purposes. Let's look at the specific holdings at the end of 2025. We see a lot of familiar fund names here: Fidelity, JP Morgan, Putnam, Allspring, and John Hancock funds, which are all professional money managers. The total value of these investments is over $5.6 million. Fixed small, fixed, fixed cap, fixed index, fixed fund. Fixed has a value of $75,040. Fixed smart retirement, fixed 2050 fixed star sig fixed dev. Fixed fund fixed is a big one, valued at over $637,000. These are target date funds, designed to adjust their risk level as the target retirement date approaches. Fixed Inc. fixed common, fixed stock. Fixed is listed at $158,210. This confirms our earlier observation that the plan's exposure to the company's own stock has been significantly reduced. The participant loans are also detailed here, totaling close to $590,000, with interest rates ranging from 3.25% to 8.5% and maturity dates from 2026 to 2030. So, what's the story here? UPBOUND Group Inc. seems to be actively managing its employee retirement plan by reducing its own stock's presence and making administrative changes with a provider switch to Fidelity. The growth in total assets is positive, but the increase in participant loans is something to watch. The shift away from company stock within the plan suggests a move towards more diversified, less correlated investments for long-term retirement security. The biggest takeaway for me is the intentional reduction of company stock in the retirement plan and the upcoming administrative transition. It signals a more conservative and diversified approach to employee retirement savings, which, in theory, should benefit participants in the long run by reducing company-specific risk. The risk I am watching is how employee participation in the plan might be affected by the administrative changes and the removal of company stock as an investment option. What I am actually looking for is sustained growth in the diversified assets and a managed trend in participant loans. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.